Saudi Arabia has imported roughly 1 million ounces of gold from Switzerland alone this year. And these numbers are fugazi. And pardon my French. Goldman Sachs just came out and said, the numbers that we told you at the end of 2025 about what we expected the central banks to be buying, they came back at the end of 2025, made a big deal that, we're going to revise things maybe a little bit more neutral because we think that the central bank demand is waning, right? Well, they just came out and revised those estimates massively upwards. Imports that we've seen are massive. And you can look at it the other way and just simply say it's very bullish for the final price of gold and silver because it proves that the physical price is worth far more than the paper price in the West, and enough to take possession of it speaks volumes. Has been selling physical to capture profit. But you look at that from a pragmatic standpoint, and you say, yes, there's this choppiness. It's trading with great volatility within a range, right? It's been that way. And that's been the way that it's always worked for the last several years. It goes way up, trades sideways, choppy within a range, butts up against resistance, falls through it, comes back, chops, freaks everyone out because of the sawtooth nature. But if you put that picture on the wall and go to the back of the room, you'll see a straight line. You won't notice that, the maddening volatility. And then it goes up again and catches everyone by surprise, and then chops, corrects, then chops. But it's higher highs and higher lows. Look, silver was $35 an ounce last year, Adam, and here we are at 75. That's wildly bullish, right? And in the same thing, look, this to me is a classic bull market sign. And when you talk about early in a major move, first of all, you get the older holders who sell into strength, and they're relieved to finally take profits. They can't handle the volatility. They have the same tenor or belief structure that you just mentioned, and they're getting disillusioned. But if the price keeps steady and even rising, if you go back and look at it from a longer perspective, it is rising and with great volatility, not the way that we would all like, but it tells you that demand is far deeper than the visible retail market. I don't know. To me, that means physical is being transferred from price sensitive weak holders to the strong holders. And I think you could say the same exact thing about what's happening in China. Now, you look at the amount of gold and silver that is going into China, it's off the charts. And I think that you could, highlight that by simply saying in the West, I'm not talking the way the government looks at this, right? I'm talking the way that the traders look at this with a 12% or $9 premium right now in Shanghai on silver, or an $85 premium in gold. Look at the amount of gold and silver they've imported. It's unbelievable. And you can see that gold and silver are moving east. We know that. They're premiums to the Western price. And we've talked about this before. I remember early in the game, you and I talked about this. We said, well, what about the VAT tax? And I dug. Mm-hmm. And the VAT tax is paid by the recipient, not the sender, not the seller, when it leaves the Shanghai Metals Exchange. And so you imagine if you're a JP Morgan trader and you take 10 million ounces, you sell it at a $10 premium, deliver it through what's called exchange for physical, in essence, where you deliver it to Brinks Hong Kong, which is a COMEX contract. It's picked up by truck and driven to Shanghai at a $10 premium on 10 million ounces. You just made $100 million. Or, wow. 1 million ounces of gold at an $85 premium, you just made $85 million. And that is what
market turbulence easily scares smaller investors into selling, but analysts believe this behavior signals an early bull market. Weak hands take profits while stronger buyers quietly accumulate. The real story isn't retail trading, but massive physical metal accumulation happening globally behind the scenes.
We've talked about the 4 glitches we've seen on COMEX, 2 to the up, 2 to the down. When it's cascading down, the circuit breakers don't work. When it's going up fast and furious, it shuts down at 11 o'clock at night on Thanksgiving night because supposedly the servers overheat. Of the 1,000 commodities traded, just the gold servers on Thanksgiving night overheated. Okay. Well, bottom line is you got the UK coming out and reporting metal that has been sold leaving the vaults not matching the export numbers. And so Goldman says, there's this huge discrepancy. It must be the central banks because they're not telling us the truth. People are getting gold that it's not being reported. So they came out and late last year and said, well, we're revising our estimates to 29 tons a month that the central banks will be buying. And then early this year, they said, well, okay, maybe it's about 50 tons a month. And now they just came out and said their new 2026 projection is, well, because of this discrepancy, that they're actually buying 60 tons a month. So they've doubled what they said. And it's happening. And that's largely because the numbers coming out of London are a lie. Just like the information coming out of the Bureau of Labor Statistics, just like the crap we see on COMEX, the Western institutions which are built on trust are being exposed as being not trustworthy. And I think that's why you're beginning to see this hoovering. Now, you and I have been talking about this arbitrage in China for a long time. And anyone who's been around finance long enough would know that when you see arbitrage, the big boys and girls in New York would say, bang, throw everything at it. And it would be over in a matter of days, right? Because they would capitalize on that arbitrage until it normalizes. It hasn't normalized in over a year. Why? Because they know that deep down these traders are motivated by greed and they will siphon every single ounce that is privately held and send it over there and it will never come back through the 22nd. So that would have been, I guess, Friday. We saw 6,633 gold contracts. So there's still a few days left. That's 663,000 ounces. Multiply that times $4,500, a couple $1 billion. And so far, silver, 5,704 contracts. That's 28,520,000 ounces again, times $75, a couple $1 billion. Silver withdrawals since the start of the year, withdrawals, meaning driving away, 158 million ounces through April. Now, 158 million ounces is roughly 15 million pounds-ish or more, 16 million pounds. So who's taking all of this metal and where is it going are the questions. So yes, they are. Now, there's also a thing that I would like to discuss real quick, and that's talking about this theory about export numbers, that supposedly we've been exporting all of this gold. And some of it is not true. I mean, it is because you can see the traders sending all of their metal that is not nailed down to China. There's also France repatriating all their gold. Well, that would show as an export, right? And it doesn't, there's no distinction. So you would see all of that metal being sent over. You would see, the metal that's being brought from the Venezuelan mines to, I think the company's called like Trafigura here in the United States, something to that degree, who then export it to Switzerland to have it refined. Not all of it's going elsewhere. Some of it comes back here. But my point is the exchange for physical, where players around the world have COMEX contracts exchange for physical, send it to Hong Kong or send it to London and then take possession. There are a lot of things happening that show up on the trade numbers as being a trade surplus, but they're really not. They are players bringing their stuff home. They are exports to refineries in Switzerland. Some of it might go elsewhere. Some of it may not. It's mining companies sending directly. So there's all of these numbers that make it look as though the last 2-3 months, we've had these huge export numbers of metal. I would argue that it's less than candid in terms of what it truly means. And
emerging economic blocs are rapidly building financial infrastructure entirely outside the Western system. New gold vaults, metals exchanges, and payment networks are expanding across the East. By prioritizing physical ownership over leveraged paper contracts, these nations threaten to permanently weaken the influence of Western markets like COMEX.
Imports that we've seen are massive. And you can look at it the other way and just simply say, it's very bullish for the final price of gold and silver because it proves that the physical price is worth far more than the paper price in the West, and enough to take possession of it speaks volume. But over the last few months, the export numbers are larger than the import numbers. Now, the question
but
is
you're saying, though, those aren't really
well, yes, because
reflective.
there's no distinction. If it's an exchange for physical, it looks like we exported metal. If we're sending metal for refining in Switzerland, it looks like we're exporting metal. And so there is some of it is real, but some of it is not as it appears. So I would think that this would be a short-term blip in terms of major exports. And at some point, there's just not enough metal to continue to send to fulfill that arbitrage. So I think it's a short-term deal. But yes, we're still importing. Every single month we're importing a tremendous amount. And so some players are importing and some people are exporting, and some are using this ability to stand for delivery through what's called exchange for physical, where they take a COMEX contract and either deliver it directly to Hong Kong or to London and then take delivery around the globe from there, to their advantage. It's part of the rules until otherwise noted. So it's not like the U.S. government is selling all of their metal. In fact, I don't even think it is the government. I think it's private players trading private metal to become very wealthy.
Okay. So let me ask you this, Andy. You noted for us a couple months ago when the U.S. government added silver to the list of essential minerals, right? Has there been any notable change since then? And I guess where I'm going with this is, okay, there's this wave of metal going from west to east. Do you see the U.S. as waking up and actually taking real measures, or maybe they will in the near future, to start slamming that window shut and saying, hey, look, this is an essential mineral. Like, we've got to, A, keep this thing here. We don't want it to go out of the country anymore. And then B, we want to go out and find more of this stuff, whether it's domestic production or international production, but get more of this into our borders.
I think they have. I mean, you ask yourself, who's taken physical delivery out of COMEX to the tune of, what did I say? What did I say? The number?
I think you said like 15 million.
Some of it, I think it's a mystery why they allow it. I think if they were to clamp down on it, it would certainly. But part of what makes a exchange real is the ability to stand for delivery. You take that away and the COMEX dies overnight. Mm-hmm. Because, someone said to me, well, could there be two prices? By the way, the exchange in India and Mumbai is actually, their premiums right now have jumped above Shanghai. The premiums in India right now it's $10.35 or 13.5% premium. So send your silver to India, you'll get even more than to China. They're doing the same playbook. But, someone said, couldn't there just be two prices, the West and the East? And I said, well, sure, there could be. But if that happens, then the COMEX is dead, because people will buy where it's priced fairly. And if you do not allow it to leave the country, then you have just, in essence, signed the death warrant for the COMEX, because an exchange that doesn't allow for delivery is not an exchange. It's something else. And this is the one thing that is kind of the hidden Achilles heel of the system. If you stop allowing those exchange for physicals, you stop allowing metal leave the country, then you will find price setting like that across the globe leave COMEX, and all of the participants across the globe will never trade with us again. Why would they? They would go to the exchanges that are opening up around the globe. And this is like the Singapore exchange that in December started selling kilo gold bars deliverable right away, not rehypothecated and financialized. They just came out last week with the 1,000 ounce silver contract, deliverable, not rehypothecated and financialized. This is what the global south buys, kilo gold bars. And instead of buying a 5,000 ounce contract that is sold 50 times over, you buy one 1,000 ounce contract that you can take possession of like that. Mm-hmm. You have to. Same thing in Shanghai. Same thing in Dubai. Same thing in Mumbai. Same thing in St. Petersburg. Same thing in Moscow. And on and on. All of these exchanges are the arteries of the new BRICS system. And they're not calling that yet because they don't want to antagonize Trump. It's trading with one another on SIPs, the cross interbank payment system, and Mbridge, both of which are operational, where you have, I don't know, over 50% of global GDP that is inside of this arena. And you look at a country like United Arab Emirates. They leave They leave OPEC. They're a member of BRICS, and they're a charter member of Enbridge. And so it's like, and now they have a vault being built as part of the expansion of the Shanghai Metals Exchange. The one in Saudi Arabia is now complete, according to reports. So you can trade your oil to China for yuan immediately, switch it into gold, not for converting into dollars, and it's in your own backyard. They're trading over SIPs or Enbridge. This is exactly the rails. This is exactly the system that they are building. And the West doesn't get it because it's too drawn out. It's not instant gratification. So they just dismiss it. But they are quietly building all of these vaults with the arteries, and the veins is SIPs and Enbridge. And these countries will trade by themselves with their local currencies, settle imbalances in gold. And the expansion of these vaults is startling how fast they're happening. Not a word by the West. Of course, the mainstream won't talk about it. But the fact that you have this new vault in Hong Kong, a new system that will coordinate with all of the other vaults like Singapore, like Shanghai, like Dubai, like Mumbai, all of them, they're popping up out of nowhere. And every single one of them are largely cash and carry. And once the West crosses that bridge and says, we're not going to allow shipping anymore, done. Just like that, it's done.
Yeah.
And no one will ever trade with them again. Globally, it would go far, far, far higher. And that's the incentive that all of the countries who are accumulating it have. The Western price is make-believe, Adam, because it's never been allowed to find price discovery. Because what is it? It's the antithesis of the Western system. Gibson's paradox, which largely speaks to the inverse relationship between real interest rates and the price of gold. And so when you suppress real interest rates, not nominal, real rates, for as long as we have, well, gold should go to the moon. So this is the incentive for stepping on gold and not allowing it to find its real price discovery. And the same thing is true of silver, where it's needed in so many major factors, from industrial to military and everything in between. I think the military-industrial complex has held it down. It's never been allowed to find price discovery, and the West doesn't get that. At least the people don't. The leaders do. But the people in the East understand this, and that's why they're using it against us and standing for delivery and keeping this arbitrage here. Come on, send it to us. Go ahead. Become rich in your dollars.
I think they love that it's low, right? If you're going to build basically vaults in stock.
That's why they're not bitching about it until all of a sudden it's delegitimized. Because remember, there's only one place in the world where price is set. Here. We set the price. So if they join into the party, suppress the paper price with money that they have coming out of their, every hole in their head, there's money coming out everywhere. So they sell the paper price and stand for delivery everywhere else, including here, at subsidized prices. You can see the playbook. I mean, at some point that stops. When that stops, and there's no one silly enough to send what is left, then you begin to see a transformation where these countries, who are now all connected with their systems and their vaulting infrastructure, will be the ones that control what the price truly is. I believe that any exchange that can say oil is -40 a barrel shouldn't be an exchange, in my opinion. Yeah, it's the old cliche of seeing the trees instead of the forest, or the leaves instead of the forest. The trees and the leaves, the rustling leaves catch your attention instead of seeing the whole forest. I believe the rest of the world has become sophisticated, coordinated, motivated, educated, and they're standing for delivery using our Western system against us, where no one ever did that. And so the idea of suppressing price is delinking the rationale that the rest of the big money in this country and others would have. Why would you look at gold and silver when it's not performing in the face of a war and inflation? It's exactly what they want you to believe. But at the same time, the Kobayashi letter came out and said that U.S. Treasury total returns, the index, has been in a drawdown for 69 consecutive months, the longest streak in over a century of records. You're talking about the asset the entire world treats as being the one safe place to park money has quietly become one of the worst performing investments for the better part of 6 years. And so what that says to me is that quietly these countries are selling treasuries to buy gold, which using the Western stupidity against us. So we don't want everyone to realize that. It's bad enough that the big money across the global South gets it, but you can see it by the deliveries. It's kind of like the casino is what is confusing everyone. If you look in the cage back there, you'll see that the big money is quietly exiting stage left with as much in the way of chips as they can. And it's the deliveries across the globe. If they were not the way they are, If you didn't see the central banks buying at the level they are, or the deliveries across the globe out of Shanghai, out of the LBMA, or out of COMEX being what they are, where the exchanges have to lie like the LBMA about how much is actually leaving, or you have to have glitches on the exchange to mitigate the price rise or to accentuate the price fall, or you raise margins 300% into the rebalancing of the ETFs the first 2 weeks of January, the stupidest time in the world to do it. You're guaranteeing a collapse. These are all things that would be emblematic of last ditch efforts to mitigate what is a trend in motion, using misdirection of price and rhetoric to reposition. And the big money has the ability to do that. And there are a lot of reasons why they don't want to be upfront about it, but I think you can see it if you take a step back. And